G'day guys, and welcome back to the Ugg Boot Investor. Today we're jumping into the Spiral of Success Part 2. It's going to be a bit more numbers heavy, but I really want to focus on how purchasing assets or investments that produce an income affects your net position over a long term, as well as if you're purchasing assets that cost you in order to hold them and what that does to you. Specifically, how that hemorrhages you in being able to progress. Last time I showed you a graph of the World's Economic Forum that showed that 10% of the population owns 76% of the world's economic wealth. Meanwhile, on the other side, the bottom 50% in comparison owns only 2% of the net economic wealth. This is a vast difference, and it really comes down to how the spiral of success actually works. So let's jump in, and you can see the examples firsthand. Alright guys, we're going to jump into the spreadsheet now. It's not going to be a sexy spreadsheet, but what it's going to do is it's going to run through, hopefully in a very systematic way, so that you can follow what the numbers look like when you are purchasing assets that either put money into your pocket or require money to come out of your pocket in order to maintain. So let's jump into the spreadsheet and take a quick look at it. Now I've created 3 tabs for this particular exercise, and we'll go through each one. The very first tab is the simplest it can possibly be. It will be just the spiral calcs that come off the Spiral of Success video that was posted last week. The second tab is to indicate what happens if you add growth into your investment. So like an average yearly growth rate. And then the third tab is what happens if your actual asset is leveraged. So something like real estate, where you would purchase something for down payment. In this particular example, we're using $20,000 of savings. That gets leveraged to $100,000 for the purchases of the asset itself. So for the examples in the spreadsheet, it would be purchasing $100,000 piece of real estate after the first year. And then from there, what happens year on year if you're able to continue to do this. All right, so let's take a quick look at this. Having a look at this spreadsheet, I understand that there's a lot of numbers here and it can be quite daunting. You need to set some of the assumptions up first. So the first assumptions that we're going to state is that, generally speaking, your income's not changing for the next 30 years. Now, will it? Yes. And I hope it continues to grow. But for the purposes of simplifying the examples here, is I'm going to keep it a stagnant $80,000 so that you and I can follow along and understand the implication of purchasing assets that either contribute to your income or cost you your income in order to maintain them. Right. The next assumption is savings rate. I'm assuming for this example that you're able to save from your income $20,000 per year. Now, I understand that that's a lot of money for some people and it's a little for other people. But for the purposes of illustration, we're just using the flat $20,000. I'm going to have this spreadsheet available online via a Google Drive link that will be in the description below. Don't forget to click the link if you want to muck around with it. You can change any of these numbers and see what the effect is. But let me run through and show you how it actually works. The last assumption for this particular spreadsheet is the investment rate. So throughout the entire time, I'm just assuming a flat 10% investment rate. Now, if you were to, for example, purchase an index fund in the stock market, you'd be looking at, on average, a 7 to 10% year-on-year investment rate. So I've just gone with 10% for the purposes of the example. It's just an illustration to see what the differences are between an asset that produces income and an asset that costs you income or impacts your lifestyle inversely. The way this spreadsheet works is that on the left-hand side is the direct comparison of purchasing an asset that costs you to maintain. And on the right-hand side is an asset that creates additional income. All right, so let's take a look down below here. What you can see is that I've split this particular table up into the income that you earn, which is broken into the salary, the raw salary that you get, and the adjusted salary you have after having to use your income to service the assets or maintain those assets in your portfolio. The next major category here is savings. So what is the savings amount that you get based off the income that you're receiving? And the last category is the investment category. And under the investment category, we've got how much are you using to purchase? What's your total investments over the course of your investing career? And what income is that producing, or how is that affecting your income on a yearly basis? So I want to show you line by line, just a few to give you what the impact is, and we'll run through how that works. So if you take a look at purchasing the asset that costs you money to maintain, year one, you start with your $80,000 salary. It's not adjusted in any manner because you haven't got any assets to adjust it. That means that you can save $20,000, which is fantastic. You can use that $20,000 after your first year and purchase your first investment. Total cost, $20,000. So your total portfolio value at the end of year one is $20,000 because that's what you've been able to save to use for the purposes of investing. Now, as we stated, what we're saying is that the income is negatively affected. So this asset costs you 10% of its value to maintain in your portfolio. That's how you interpret this particular column. So what happens here is that year two, you get your $80,000. Then you have to subtract the $2,000 income that it costs you to maintain your existing asset that you purchased last year. Therefore, your effective savings rate is now $20,000 minus 2, $18,000. This was discussed in the Spiral of Success video. The effect of this is that in year two, you can only purchase a new asset with a maximum of $18,000. So if you do this, the total assets that value that you have is $38,000. But of course, if this $18,000 asset once again costs you 10% to maintain it in your portfolio, that eats into your income, $3,800. And so the cycle continues. Your adjusted income the next year is $76,200. Your savings decreases. Your ability to purchase assets decreases. The income to support those assets increases. And it's a spiral that gets out of control. When you look after 30 years of doing this, so a working career, at the end of 30 years, your $80,000 salary becomes an effective $60,900. You're not able to save as much because all of your savings that you have been diligently pushing towards is going towards maintaining those assets. And interestingly, the total value of the purchases that you can make after 30 years is $191,000. So I mean, like that's a decent outcome, but it's not anything like what the power of income producing assets is able to do for you. So if we take a look at the other side, exactly the same principles. Start with $80,000 salary. You're able to save your $20,000. Therefore, you can purchase a $20,000 asset. So your total is $20,000. And your income or income from this asset is added to your effective salary. Therefore, your adjusted income for this year is $82,000. So the net between an asset that costs you money to maintain in your portfolio and an asset that produces money in your portfolio, for this example, is $4,000 because it's plus 2 here, minus 2 on the other side. So next year, or year 2, for the person who's using their income to purchase assets that create additional income, means that their savings has gone up to $22,000, and they can use $22,000 to purchase their next investment. So their total investment cost becomes $42,000, and then their income $4,200, 10% of that total value. As you can see, this starts to spiral, exactly like what we were talking about in the video previously. When you go down to the 30-year mark, if you continue to maintain this, assuming your income doesn't change in 30 years, so it stays stagnant at $80,000, your effective or adjusted income is $377,000. What that means is that if you were to stop working, subtracting your $80,000 income, your stable job, then your income from your investments would be $317,000. Well and truly more than enough to replace your lifestyle. And that's kind of shown in this column here. What's very interesting is the fact that as additional income comes in, which allows you to purchase more assets, those assets' total value in your portfolio would be well over $3 million. So inversely, if they're costing you money to maintain, $191,000, if it's making you money on the process or on the journey, it's creating $3,280,000 of net equity position for you. So I wanted to graphically show you what this actually looks like. So, because some people don't really follow the numbers, and I understand that, because numbers aren't as easy to see, but I really wanted to break it down one step at a time. So let's take a look at what it looks graphically. So here is investment value. This is the first one. Now, I've only put 15 years on this particular graph, mostly because it spirals out of control, and it's very hard to see what the impact is on the curvature of the graph for the costing money side of the equation. So what you can see here is that the investment value for an investment that puts additional money into your pocket starts to spiral an exponential curve going upwards. Inversely, if it costs you money to maintain the asset, the curve goes in the opposite direction. Now, it'll never go down, right? Because you're still maintaining a savings rate for the purposes of this example, but it's not going up. It's going to get capped. There will be a finite number where it eventually just gets capped off. So what's really important, though, is the investment income that is provided for you. In order to maintain the assets that you're purchasing that cost money, you have to continue to work to supply income costing your lifestyle in order to produce or maintain those assets over a long period of time. Meanwhile, the income from the assets that are providing additional income, they get to a point where they're able to replace your income, your salaried income. And it doesn't take as long as you think. It takes roughly 18 years to replace your $80,000 income by diligently saving $20,000 and putting that money away for investing purposes. If we take a look at some other graphs that are indicated here, savings power. Let's take a look at savings power very quickly. It's a very similar trajectory to the previous graphs of the value, except it's really based on income. Now, income is what allows you to exact retirement. So as an asset produces additional income, that income is put towards your savings power or additional investing power in the future, and that grows. So if you maintain a consistent investing path where you're trying to add assets that create income into your portfolio over the long run, this is the effect that it's going to have on your net worth and your income. Well, you might be looking at this and going, well, that's all good and well, but you're not really showing any growth in the assets over a period of time. How does that actually affect what's going on? Because I might be looking to purchase a negative geared asset, so one on the table on the left, over a positive geared asset if I think that it's going to be worth more in the future. So let's take a look at that. I've created a second tab here where we look at what growth is. The assumptions here at the top are generically that both assets are going to be increasing at 4%. And we'll change that in a second to show you what the effect is. But how it works is none of your income, savings, or purchasing and investments change. But now what we're doing, we've added an additional column in. This column here, the growth column for the investment, takes a look at if the asset that you existingly hold was to grow at an average rate of 4%, which is what we've specified above, what does that do to your net worth over 30 years? So let's take a look at it. Year one, if you are able to purchase your $20,000 asset, nothing's changed. You have $20,000. There is no growth in year one. But at the end of year two, there is growth on your initial $20,000. So in this example, the income has decreased your savings ability, which has decreased your purchasing ability. So in year two, you're able to purchase your $18,000 asset, same as before. And instead of the total being $38,000, the growth is $38,800. How did we get that? Well, I don't know if you can see the formula here, but the way that it's working is it takes your first year's asset and adds 4% onto it, and then it adds the current year's asset to that portfolio. So you can see it starts to grow. In the third year, it takes the total of the second year and adds 4% to it. So now we have this situation where your portfolio is growing at 4% year on year, and you're adding additional assets to it. What does that look like as a portfolio that costs you lifestyle to maintain or provides you additional income? How does that look after 30 years? So now what you can see in these graphs of the value with growth is that there is some growth in the bottom curve. It's gone up. Instead of $191,000 for assets that cost you money to maintain, their net worth after 30 years is $457,000. So it's almost tripled in value. Meanwhile, the assets that provide you additional income, instead of them being worth $3,200,000, they're now worth $4,700,000, as they have also increased 4% year on year. The graphs have changed slightly and the numbers have increased, so it's not looking as bleak if you're able to do this. But there is still a significant difference, because the power that income provides to be able to continue to invest is astronomical. And this is the point that I'm trying to get across. Now, once again, you may look at this and go, well, that's all good and well, but what if the asset that is costing me a lifestyle sits in a major city and I expect it to grow at 6 or 7% per year? Meanwhile, the asset that you're talking about sits outside of a major city and it's only going at 4%. Let's change it. Let's take a look. So if we raise this to 8%, the numbers have changed. The graphs will change. The value at the bottom of the spreadsheet now is $1,100,000. So you still are 4 times, almost 5 times worse off of purchasing an asset that does not provide income versus an asset that has additional growth over time. And this is really important to understand because a lot of people go for the growth. And there's nothing wrong with that because your position over a long period of time is still going to be healthy so long as the asset continues to grow in value. The more effective method is to use assets that provide additional income because it doesn't matter if the asset itself grows in value over time. What matters is the asset provides an income which you're able to use to support your lifestyle. Now you might be looking at this and going, well, that's all good and well. But if we're talking about real estate as an asset, you need to take into consideration leverage. And if I'm using $20,000 as a down payment, that means that I'm purchasing a $100,000 piece of property. What happens if everything is leveraged? And this is a good question. I've got a spreadsheet for that. Let's take a look at it. So this one's a little bit more complicated. We're still using the same assumptions. $80,000 of your income, $20,000 savings each year. The investment rate remains the same at 10%. For the purposes of this particular example, we're going to hold the costs at 4%, or the growth of the investments for both sides at 4%. Let's take a look at the spreadsheet to see how it all works. Income remains the same. Then you've got your savings for the year. What that means is how much can you use to purchase, what that asset does from an income effect position, and then what is the amount that you can actually purchase if you were able to borrow the remaining amount or leverage your money in order to purchase property. So $20,000 down, $100,000 investment real estate. We've added some columns to tally up what the total value of those real estate is and what the growth in that real estate is over a long period of time. The last column is net, and it's the difference of net debt and net worth. In the previous examples, you will have seen that we were not using debt in order to purchase the assets. Here, we're using debt. So we are approaching a financier and asking them to borrow at an 80% LVR in order to purchase these investments. So you need to take into consideration what is your debt or what is your exposure to the market and what is the asset's net price. The difference between those two is your net worth. Let's take a look at it. It's a little bit more complicated, so just bear with me. You start off with your $80,000 for year one. You're able to save $20,000. You use that $20,000 to purchase a property worth $100,000, leveraging your money. So your total portfolio at this stage is $100,000. There is no growth in year one because that's the year that you purchased your investment. But you do have $80,000 of debt. If you have $80,000 of debt for year one, you have $20,000 of net worth because it's $100,000, your asset total, minus the debt or the exposure that you're into the market. Let's take a look at year two. For the person who is purchasing an asset that costs you money to maintain, and this is a very real example in real estate, their adjusted income goes down, doesn't change from any of the previous examples, which means that their savings goes down, and so their ability to purchase an asset decreases. So an $18,000 savings amount means now you can purchase a piece of real estate for $90,000. You might be thinking, $90,000, you can't do that. I understand the principle. The idea is that you understand the effect of what leverage has on the impact of a portfolio. So you just have to bear with the numbers for the moment. That means your net or total position in the market is $190,000, but you've had 4% growth on your 100 grand. So your net position or your net growth position is 194. Your debt is 172,000 and your net worth is $22,000. As this goes down all the way to the bottom, you can see that the numbers start to get out of control, which is quite interesting. And this is because the leverage is applying a positive factor to you, so long as you can maintain it. If you cannot maintain the property in your portfolio, you will have issues in the future where the banks might call notes and then you'll be forced to sell at a discounted rate. So we're ignoring that fact for the moment and assuming that you can maintain the real estate that you're looking to purchase. So what you can notice here is that your total position is over $2 million. So where previously, in order to have a $1 million portfolio, you needed to have an 8% year-on-year growth, which is extraordinary for an asset class. Now you're more than double that just from the effect of leverage. The interesting thing is your debt position is almost $1 million and your net worth position is $1.3 million. So you may sell a few of these assets, consolidate the debt, and you would end up having a net worth of $1.3 million. What's really interesting is the same thing happens on the other side of the equation, but it spirals out of control even further in your favor. The net asset position after 30 years becomes $23,600,000. That is a considerable difference to the $2 million odd dollars from the other example. The assets on this side are easier to maintain because you are using the income that it produces to service the assets itself. Interestingly, you have a larger debt position of $16 million, but your net worth is $7.5 million. So the way that you interpret this is your exposure to the market is a portfolio of $23.6 million. Your net worth position is $7.5 million, and the amount of money you owe back to the bank is $16 million. That's how you interpret this. But the income is the critical part. It's providing you additional income that supports your lifestyle. That income pays for all of the expenses of property management, the interest rates, the principal, the maintenance, etc. Understanding that as an assumption for this particular model, this is how you can use real estate to grow your portfolio. Let's take a look graphically at how this looks. Now you can see that because we've added leverage, the cost money line, so the blue line down here, is actually growing in a positive direction. And that's because leverage is applying that growth over a long period. So it's now an exponential growth curve too. It's just much, much slower. Meanwhile, the assets that produce income continue to grow at the same rate as it grows upwards here. To give you an indication, if you were to provide 8% to the assets that were costing you money to maintain, the total position would be $4,600,000. So that's not a bad outcome after 30 years, but it's a lot harder on your lifestyle. It's a lot more stress on your life as well. I would encourage you to look at this in detail, get your head around the difference between an asset class that provides you additional income and an asset class that costs you money to maintain it in your portfolio. Most people purchase assets that cost them money to maintain, specifically when they're dealing with real estate. I'm encouraging you to think a little bit different and find assets that provide additional income into your portfolio. This is the effect that it can have on your life. And it can be quite enormous. Thanks for sticking around to the end of the video. It means a lot. We've taken a look at very simple calculations through to more complex leveraging situations. They can be applied in circumstances such as purchasing shares online or purchasing real estate. Consider when you're purchasing these assets, do they provide additional income? Do they cost your lifestyle? And now you understand a little bit about the impact that it can have on you over the long term. This tool is going to be available. There'll be a link in the description below. You can muck around with the numbers to your heart's content. Go for it. Use it as a planning tool to help you with your next investment. Thanks for sticking around to the end of the video. I know numbers can be a little daunting. Some people get it very easily. Some people don't. That's why we're working through it together. We're using this as dinner tabletop conversation. Let's get that conversation going. Let's get those financial fundamentals happening in the household. Let's all work together to increasing the understanding of how finances work. Really appreciate that you've taken the time to stick to the end of the video. Don't forget to hit that like and subscribe button, and we'll see you on the next one.